Let us take a look at the broader market. The S&P 500, certainly a lot of volatility today. The S&P down nearly 25 points at one time, now down just 2 points. Craig Johnson, technician with Piper Jaffray, Aaron Gibbs with S&P Capital IQ. Craig, I'm going to start with you because when we see these big reversal days, often, not always, but often, they can mean something technically. Does this reversal today mean anything?
Brian, I think it is a very interesting reversal, and I think the best phrase I heard all day today was from Robert Cagle on our trading desk is never short a dull market. Now, I'm not sure he coined that phrase, but when you have very limited trading volume like you're seeing across a lot of desks across the street right now, you can see these kind of reversal days unfold. That's exactly what we have seen happen today. Came right down to the rising 40-week moving average and have seen support hold, and we're starting to rally off of that level. Now, as we look at the shorter-term uptrend support line on that chart also, we found support there and at that 200-day moving average. So it looks like to us, we're finding some footing here, at least short-term. And to us, it's a very good sign when the market sells off hard in the morning and starts to claw back those losses at the end of the day. And we've seen that now for 2 trading sessions in a row, which tells me that people want to own this market despite all the negative sentiment that we are hearing out there constantly, day in and day out, about Greece and China and other markets.
All right, well, Aaron, I guess, listen, let's talk about earnings and maybe people that are not timing the market. Let's look at a little more long-term because earnings season is about ready to kick off yet again. There's 4 of them a year. It's hard to believe that. Anyway, when you look at the earnings expectations for the S&P 500, do you see more equity gains ahead, or have we peaked out valuation-wise?
So actually, valuations look a lot more reasonable. This is the best we've seen it all year, trading at about 17 times forward earnings. Going into earnings season right now, we have really low expectations. Right now, looking at about a 4.3% decline, mostly because of energy, but there are 5 sectors with either negative or very low earnings growth. So very low expectations. Now, if we have an earnings season like we had last year, where 80% of the companies beat estimates, it went up about maybe 5% above where we started the quarter, great, we could end up with a really good quarter. So but that remains to be seen. That it may happen, it may not. We couldn't actually end up in the red the first time since 2009. However, second half of 2015, earnings are looking great. In some cases, 2 to 3 times of what we're looking for in the second and first quarter. Also, very strong revenue growth for the second half. That's where I expect the pickup. And when people start focusing on the second half, I also expect the market to pick up.